Welcome to another week of the Financial Armor Show. My name is Brad Cooper, the president of Cooper Financial Investments LLC, and I just want to welcome my co-host today, Tony Shore. How are you doing, Tony?
All right. I am so good, Brad. If I was any better, my name would be Brad Cooper. That's how great I'm doing today.
Well, you must be doing good then.
Oh, I am. Oh, I'm doing great. I've had a great week, and we're headed into the Thanksgiving
Yes.
holiday, and I have a lot to be thankful for. I think we all do. I know I do at least, and I'm really appreciative of family and friends and coworkers and friends like you, Brad.
Amen to that, Tony. Just such a great time of the year where we can reflect and just be thankful. As I sit down day in and day out with clients and friends and just hear the trials and tribulations that everyone's going through, we can always find something to be thankful for. So,
Yeah.
and then too, in addition to going into the holidays, lots of food, which I like.
Yes, yes, and of course, there's the food, and
That's
that's
right.
that's one of my favorite things about
Well,
Thanksgiving.
when you look at the holidays, you got to look at the good things, right? You have food and you have in-laws and outlaws. So,
That's true.
so,
That's true.
so
Yeah.
you just got to, be thankful for the food and the in-laws, of course.
Maybe not so much the in-laws, but the food is great,
Hey,
Brad.
that's right.
Yeah, but we love to make a really big turkey, the mashed potatoes, the gravy, the stuffing, the cranberries, the whole works, usually a green bean, the casserole thing.
Oh, sounds so
But
good.
it is going to be good. But what I love even more than the Thanksgiving meal is leftovers the next day.
You're right.
Making that turkey sandwich with some mayo and that leftover turkey, season it. But what you do is you put it in a frying pan, take the pieces of leftover turkey
Yes.
with some butter in a frying pan, season it like you like, and just brown it lightly on both sides, then put it in a sandwich, maybe even a little cheese on top, some mayo. So good. So good. That's my favorite part of Thanksgiving, I have
You
to
know
say.
what? You're making me so hungry. So let's just spend the next 20, 30 minutes just talking about food and recipes.
No,
And I think that will be a bigger hit than some of the topics we've talked about in the past. The
no, no.
economy.
You're going to talk about what market condition, forecasting, taxes.
And a lot of those topics and RMDs we're going to get into a little bit more and some
Okay.
solutions that you may or may not be familiar with.
Okay.
You know, I had the privilege this past week, Tony, of being interviewed by Channel 13 KOLD, a CBS affiliate in Tucson,
Yeah.
and and some of the topics that we talked about and I was asked about was what we're going to cover, on today's show. And a lot of times, the most common question we get is, Brad, I'm watching the news and it's gloom and doom. What are you hearing? What's the forecast as far as the market and what's going on? So I know we talk about that often, but right now we have been seeing a lot of volatility. Last year was ugly, of course, but the
Yeah.
forecast that we have still received this past week. We interviewed the president of Gradient Investments, Mike Binger, and he gave a good forecast. We're still hearing the same. The next 5 to 7 years, our experts are still forecasting positive years. But with that, there is going to be a little bit of volatility and bumps in the road along the way. So,
Yeah.
and how could that impact you, Tony, myself, a pre-retiree, or especially if you're in retirement? What I talked about on TV was what you really got to focus in on is look at your risk. Because here's what I identified over the past several years is your definition of risk may not match the definition of risk that your investment firm or your investment advisor has you in. So it's one thing to take risks, Tony, when you're 35 and you have
Yeah.
time on your side. But when you're approaching the old age that we are and older, you know, our years are numbered. And we really got to focus in on risk and not take too much, because we will see another downturn. And if we see a 20, 30, 40% downturn in the market, that could be detrimental to a person's retirement portfolio.
Yeah, if they don't have a plan and have their assets allocated properly, is what you're saying.
Absolutely. And that's something that, as a fiduciary, we really focus in on is we take risk very serious. And here's what I found. It's important to make money on your money, especially to keep up with inflation. However, protect what you have is just as important, and not drop in value, because you may never recoup that in your lifetime.
Yeah. Yeah, and that is huge, and you wanna make sure that you have enough money to last throughout your retirement and live comfortably. That's the goal here. So what's one of the first things you wanna talk about?
I know we've hit on taxes off and on, and I'm just going to touch on that a little bit on this show, and then which is going to lead into what we have been very busy with for the last 45 days or so is RMDs, required minimum distributions,
Sure.
which tie into taxes as well. But
Yep.
a question and a conversation that comes up daily, Tony, is what other areas, Brad, are you seeing that could be a risk other than market risk, of course, for a retirement portfolio going into retirement or for the next 10, 15, 20 years? And the topic that continues to come up is taxation,
Yeah.
taxes, future taxation. And we talked about this a lot of times, where right now, if you look at federal income taxes, we are at about a 75-year low. So in your lifetime nor my lifetime have we seen federal income taxes as low as they are now. That's the good news. You ready for the bad news?
What's the bad news, Brad?
Bad news. Everything that Trump put into place as far as tax savings back in 2018, all of that's going to sunset and
Hmm,
come to an end December 31st of 2025. So what that
wow.
means for the average American, the average investor, saver is 2026 and beyond, especially as we approach 2030, we're going to see federal income taxes increase for many reasons, other than the deficit and baby boomers retiring and exiting the workforce and the continued spending our government's doing. And that could have a major impact on your retirement monthly income check that you're receiving.
Yeah. So, and obviously, taxes are big, and people don't think about taxes in retirement maybe because they think, well, once I get to retirement, my taxes will be so much lower. I'll be in a lower bracket because I'm not working and earning all that money. But you still have an income in retirement. Even Social Security counts toward a taxable income, right?
Absolutely. And there are going to be that small percentage of Americans that won't have to worry about federal income taxes. But
Right.
the majority of my clients who are 60s, 70s, even early 80s, I ask everyone, during your working years, you saved, you socked away money in 401ks and IRAs because your financial advisor, your CPA probably said, you don't have to worry about paying taxes when you retire. How's that working out for you? And
Yeah.
Tony, I would say probably 95% of my clients are paying more taxes now than they were when they were working.
Wow. Okay. So people paying more taxes now than when they were working. That is probably a shock to some people out there to hear that they could possibly be in that situation, Brad.
And here's some of the reasons why that occurs, Tony, is when we retire, you start receiving Social Security. And depending on the income level you're at overall, there's a chance your Social Security may not be taxed at all, or maybe 50% of your Social Security may be taxed, or up to 85% of your Social Security is taxed. I would say the majority of our clients, Tony, are taxed. 85% of their Social Security benefits are taxed. And I just sat through a webinar a couple weeks ago with a few of our tax experts, and the forecast and what they're hearing is they strongly believe in the years to come that we will be taxed at 100% on our Social Security.
Wow.
which
Wow.
is disturbing because
Yeah.
guess whose money that is? That's
Yeah.
our money,
That's
and
our
we paid
money.
into it.
Yeah.
So you have that. Then we have a lot of clients that get pensions.
Yep.
Then, of course, that's taxed. And then what we're leading into with the next topic is really putting our average client over and increasing them normally to a higher tax bracket. And that's because of RMDs.
Yeah, which stands for RMD, stands for really massive donut, right?
That's right.
Isn't that right?
Now you're
No?
talking my language again, food. Now that would be the good news. So
Yeah.
when you take your first RMD and take a big chunk of the donut, think about that donut before tax time, then you'll realize it doesn't stand for that.
Yeah, yeah, that donut isn't all
Oh,
yours. Some of it belongs to Uncle Sam, but it's really a required minimum distribution. That's what RMD stands for.
right.
You know me, I just always have to relate it to food, I guess.
I'm with you.
Can't get off that topic today.
And speaking of food, the more you pay in taxes, the less food you can buy. So this is
Yeah,
a very
there you go.
important topic. But so let's talk a little bit about RMDs. What is a required minimum distribution? If you're not aware of that, right now the law states that if when you turn 73 years old and you have pre-tax money, that could be IRAs, 401ks, 403bs, anything pre-taxed, the IRS will start requiring you to take a required minimum distribution, which is a percentage of the balance of your account the year before, ending in December 31st of that year. And that percentage normally starts out about 3.5, 3.6, and it's based on your life expectancy. And each year you get older, that percentage increases. So for a lot of Americans, that's not a big deal. But for a lot that have most of their wealth in IRAs, 401ks, and I'm seeing that, Tony, on average, I would say 80% of my clients have over 80% of their portfolio in
Wow.
pre-taxed money. And the higher amount of money you have in an IRA, 401k, the higher your R&D is going to be.
Yeah. Yeah, and so, and especially, it's not good if people don't need to take that money out to live on in the first place, or they have other sources. They can use Social Security. They can use maybe something that they have in a tax-free or an optional account. Those RMDs from those tax-deferred accounts, you have to take that money out and pay taxes for it, whether you need that money or not. And that's tough because people think, oh, I've got $100,000 in this IRA here, but they really don't. Like 30% of that could be is probably Uncle Sam's, right?
Absolutely, and that's where the taxes are now. In the future, different story. But
Yeah, it could be
just
45%.
right, and just to add from what you said, and that's what we're finding a lot of clients when they hit the age of 73. It used to be 70 and a half. They identify, wow, now I have to take an RMD. So
Yeah,
what we're seeing with a big portion of our clients, by the time they're forced to take the RMD, then that's added to their pension if they receive one, then added to their Social Security check. A lot of times we're seeing our clients jump into a much higher tax bracket just because of the RMD, because they have limited options, which they do have options though, which we're going to talk about what you can do with your RMDs to either save money in taxes or what other alternatives of tax-free accounts are there. But that's one thing. And then I want to add, since this is at the top of my mind and we're seeing a lot more of these with our clients, is beneficiary IRAs. And Tony, since the laws changed January 1st of 2020, and the revision of the Secure Act, CARES Act 2.0 in January 1st of 2023, basically one major change, which is an impact on beneficiaries, is if you inherit an IRA, now the IRS will require you to fully liquidate that IRA in 10 years. If not, you would be subject to a 50% penalty. However, they didn't stop there. They basically added on and said if the person you inherited the IRA from was over the age of 70 and a half or 73 and already receiving required minimum distributions, then not only do you have to liquidate that IRA in 10 years, but also you have to take required minimum distributions each and every year.
Wow. Okay. So that's good to know. And I think a lot of people don't realize all the ins and outs of RMDs. Now, there is good news, though, right? In that they keep extending the age to when you have to start taking RMDs. Used to be 70 and a half,
Mm-hmm.
which always frustrated me, the government with these half years. 59
Right.
and a half, 70 and a half. We stopped celebrating. I think the government needs to realize people stop celebrating half birthdays when they're 6 years old. So
That's right.
uh, we don't celebrate half birthdays, but now it's what? Then they moved it to 72 or 73.
It's 73 now
Yeah.
until the year 2033. Then it
Which in the,
increases.
to
Go ahead.
75, right?
Yes, 75 years of age by the
Wow.
year 2033. Now,
Wow.
keep in mind, that's the law as of today. Now, there
Right.
is talks in Washington, D.C., which we got updates from some of our tax experts that are tied into D.C. And believe it or not, they're talking about, and they have been, nothing's gained traction yet about bringing the age down to even 65 or 60 and start requiring RMDs even at an earlier age. Why would they want to do that?
Yeah,
Tax,
that's true.
taxes, taxes,
Taxes. Yeah.
taxes. Somehow, some way, Tony, we're going to have to tackle this approaching $33 trillion debt. And
Yeah. They're
so
going to raise taxes. You know they are.
they are. So,
Yeah.
with that in mind, if you're not sitting down at least a couple times with your CPA on an annual basis, especially the fourth quarter of each year, I would encourage you to start doing that because there is times of making changes by December 31st if you need to, but that's one thing you should be doing with your CPA and also your financial service professional as well. That's why we are so busy right now in the fourth quarter is the planning process number one and also the processing of required minimum distributions. But let me give you some good news. We've been talking a lot of negativity toward taxes and overpaying taxes. And just, let you know, Tony, and I know we talked about this before, I'm okay with paying taxes. I believe that's important as an American. We live in
Well,
the
sure.
greatest country, the United States of America in the world.
Yeah.
However, I don't like overpaying taxes just because I was given the lack of education and knowledge from my CPA or for
Right.
my financial service professional.
Yeah. You
That's
don't
why
want to
we
pay more than your fair share. You want to play by the rules. But if the rules allow you to pay less, it's crazy to leave that money on the table, isn't it?
absolutely. So here's a very easy solution. I just had a call, actually a couple calls this past week from clients, and here is one way that you can either minimize or even remove the tax liability of a required minimum distribution. And it's interesting. I did a speaking engagement, Tony, about a month ago, and there was about 50 people in attendance. And I said, just by a show of hands, who's over the age of 70 and a half? And about 95% of the people raised their hands in the room. So we had a little bit older group. And then, secondly, I said, how many of you are aware that you can take money from your IRA and give it to a nonprofit, to a charity, to your church? And if you do that and you do that properly in an organized way, which we do, that money is 100% tax free to you. You know how many
Yeah.
people raise their hands?
How
Maybe
many?
3
That's
out of
it.
50.
Wow.
So
Wow.
What I'm talking about, and we've touched a little bit on previous shows, Tony, is QCCs, Qualified Charitable Contributions or Qualified Charitable Distributions.
Yep.
Basically,
QCD. Yep.
basically the IRS will allow you, if you're 70 and a half, to give money, and this could be your RMD or a portion or all of it or even more, up to $100,000 per year per person. You can give money that comes directly out of your IRA and goes directly to your charity or church. And when that happens and does not touch your hands, you do not have to pay taxes on
Yeah.
that money.
And so if you want to give anyway, if you're already giving, it's a win-win because you're helping out a charity. And a lot of people, Brad, and I think I've mentioned this, but a lot of people who tithe regularly to their church can
Right.
utilize this because if you have an RMD that you have to take, why take it and pay taxes on it when you could use that? Why write a check? If you're writing a check to a charity, you're making a mistake, right? Because if you
Absolutely.
have it directly transferred from that tax deferred account like an IRA into to the church, that's your tithe. You have that done once a year and you don't pay taxes on the money. The church doesn't pay taxes on the money, or to a charity. I'm using church as an example
Right.
because I happen to know a lot of people who tithe regularly and they might cut a check, once a month or once a year or a couple of times a year to their church. And if they're of the right age and in the right situation, a QCD would be much more beneficial to them and to their church. Yeah.
Absolutely. And it's a win win situation. So it's so much fun. So I would encourage you, and just to take a pause for a minute, because I want to make sure our listeners know if you have questions on what we just talked about, want more clarification, or if you want to just sit down absolutely for a free visit and talk more about how you can benefit from this topic we just talked about, call our office. You can reach us at 520 543 8345. Again, that's 520 543 8345. Or you can visit our website and fill out information there at financialarmorshow.com. Again, that's financialarmorshow.com. And we would be more than honored and pleased to share our wisdom and knowledge and get our strategic partners and our tax experts involved if we need to help you. So, lastly, I know we're starting to run out of time a little bit, but let me talk about what's exciting, because a lot of our clients, Tony, they basically say, okay, Brad, we're giving, but what else can we do with our required minimum distribution other than maybe just invest it in our portfolio? That, of course, is not a bad thing. But then in return, the money you make on your portfolio, guess what you got to pay? Taxes. So that word again, taxes, comes up. So I just want to touch on, which I don't think we have yet, Tony, on this show, um, another tax free strategy. And I'm just going to touch on the basics, and we're going to have probably an entire show dedicated on this topic in the future, because I have found that through talking about this strategy, the majority of my clients, the majority of my appointments, when I'm doing speaking engagements, I would say probably 95% or more, maybe even 98% or more, are not familiar with this strategy, which is a shame. And what I'm going to talk about is exactly where I have a big portion of my retirement. But when you mention this name, a lot of people turn the other way. They don't want to hear about it. And one way that you can put away money in a tax-free account, in addition to Roth IRAs, which most of us know, is a concept or a strategy called life insurance, indexed universal life. If you ever hear us talk about IULs, we're talking about indexed universal life. So when I first started bringing this up years ago, because this is what the wealthy have been doing for years, Tony, they've been socking away money into these types of accounts for years. They're not using it for the most part or leveraging this strategy for life insurance. And if you ask 9 out of 10 of my clients if they want life insurance, all of them would say, or the majority, no, we don't. But here's where we're leveraging and using this strategy if it's a right fit, which
Right.
we're
They don't
finding
understand the benefits of cash value life insurance, right?
right. And how we're leveraging this is the money that goes in to this IUL
Yeah.
is basically after tax money, but then the money that goes in, it grows tax free. Then you can participate in many different indices, just like a brokerage account. So my average IUL has averaged, over 6, 7% the last 5 years. Not bad for tax-free money. In addition to that, another benefit, Tony, is I call this a green money account. When I talk about green money, I talk about your money is protected against market loss.
The principal is protected. It's not going to, the account value isn't going to go down.
That's right. Especially like in 2022, none of our clients' money went below due to a negative loss in the market. It stayed flat due to no market loss.
In
But
the IUL.
in
If they had the IUL, that didn't happen. And when you say it grows tax free, the principal and the growth, it all comes out tax free when you need to take money out of it, right?
that's the beautiful thing of it is basically it's similar to a Roth IRA. What often I call this, and I hear this from our industry, as a Roth on steroids.
Yeah.
Why? Because you get the same benefits, tax-free growth, tax-free distributions in the future if you need it, but there's a couple other benefits you get in addition to that that you don't get with a Roth. God forbid you die early, it has a tax-free death benefit. Also, in addition to that, a lot of the strategies we're using with IULs have a chronic illness benefit, basically paying out long-term care benefits if there's an in-home healthcare need, a long-term care need, and that's based on if you cannot perform 2 of the 6 ADLs, activities of daily living.
Yeah.
So, what a great strategy that we're using in addition to Roth IRAs for tax-free growth.
Yeah. Yeah, amazing. So I think that's really a great vehicle and tool for people. This has been a great show. We've covered a lot, Brad. Let
Yes.
our listeners know one more time how they can get a hold of you before we go.
Yes, feel free to call us at 520-543-8345. Again, that's 520-543-8345 for a free visit and or visit our website at financialarmorshow.com for more information.
All right. Great show today, Brad. And listeners, that does it for today's episode of the Financial Armor Show with our host, Brad Cooper.
Thank you, Tony. See you next week.